Hello, this is Rico from realdeepvalueinvesting.com, and today I'm going to talk about the stock I first bought and sold, which is Sears Hometown and Outlet Stores. I bought this stock based on a net tangible asset strategy. The stock is listed on the New York Stock Exchange with ticker symbol SHOS. First I'm going to talk about the company, and then I'm going to discuss the company's fundamentals. And then of course I'm going to talk about my investment return with this stock. So Sears Hometown and Outlet Stores is a national retailer primarily focused on selling home appliances, hardware, tools and lawn and garden equipment. And here you see a nice picture of a Sears Hometown store. The company operates through two segments, namely Hometown and an outlet segment. The Hometown stores are designed to provide customers with in-store and online access to a wide selection of national brands of home appliances, lawn and garden equipment, tools, sporting goods and household goods depending on a particular store. The outlet stores are designed to provide in-store and online access to purchase new, one-of-a-kind, out-of-carton, discontinued, obsolete, used, reconditioned, overstocked and scratched and dented products. Okay, so the total revenue of Sears in 2017 was $1.72 billion US dollar, and 68% of this revenue was generated by the Hometown segment, and 32% was generated by the outlet segment, and most of the company's revenue was generated by the appliances product types, you can see in this pie chart. Now I'm going to discuss some company fundamentals that are key in deciding whether or not to invest in this stock. So the following criteria have to be met before considering conducting more research on the stock or before considering a purchase. So the price to net tangible asset ratio has to be below 40%, because in that case there will be enough, the margin of safety will be large enough. The debt to equity ratio has to be below 25%, because you don't want to buy a company with a lot of debt. And the current ratio has to be higher than 1.5, so the current assets have to be 1.5 times larger than the current liabilities. So the net tangible asset calculation is total equity minus goodwill minus intangible assets. The total equity came in at around $271,000, and there was no goodwill at the time of purchase, and the intangible assets came in at about $1.5 thousand. So the NTA per share is about 269. So the NTA in total is about 269,000 US dollars. The shares outstanding at the time of purchase was about 22.7 thousand shares. So the NTA per share was about 11.91 US dollar per share. I bought this stock for 3.35 US dollars, and therefore the price to NTA is 28%, which means that I bought this stock with a discount of more than 70% to NTA, which is very nice. So this is definitely a pass. The other criteria is the debt to equity ratio. This ratio has to be lower than 25%. So at the moment of purchase, the company had a total debt of about $27,000. It has an equity of about $271,000. So the debt to equity came in at 9.9%, which is way below the 25% mark. So again, this criteria is a pass. Then the current ratio, which has to be at least 1.5. Well, the current assets were about $409,000. the current liabilities were about $196,000, so the current ratio came in at 2.09, which is larger than the 1.5, and also therefore the current ratio criteria has been met, so this is also a pass. Okay, so when I bought the stock, it met the criteria of the price to NTA. The debt to equity was lower than 25 and the current ratio was above 1.5, so the current assets were at least 1.5 times the current liabilities. So when I bought them, they were all green, as you can see. But after the 12 months mark, I checked the criteria again, and at that time the price to NTA was 26%, which is again below the 40% mark, because when I sold them, after the 12 months mark, the share price was $1.86. So the price to NTA criteria is a pass. But however, the debt to equity ratio increased significantly from 9.9% to 70%. And the current ratio was 1.78%, so it declined a bit, but not below my 1.5 criteria. But the debt to equity ratio is way too high, and therefore I don't consider this stock as a good investment, and that's why I don't want this stock for another year in my portfolio. And therefore, that was one of the main reasons I sold this stock. So now take a look. Now we are going to take a look at my investment return, which was a bit painful because straight away after the moment I bought the stock price declined, and it declined significantly. So after 4 months, I had an unrealized loss of minus 40%, which wasn't that great. And after 7 months, my unrealized gain was minus 55%. So that wasn't that great. After 11 months, there was a short squeeze, which so the share price increased significantly, and I even had a small unrealized profit. So I thought maybe everything is going to be alright. But unfortunately, after the short squeeze, the share price dropped again, and after the 12 months mark, it was time to sell. So after 1 year, I had a negative return of 53%. So my first stock wasn't that successful. Let's hope that the other stocks will have better returns. I hope you enjoyed this small video. If you have any comments or questions, please leave them in the comments box. Thank you.